Amazingly bullish news for coin yet again because Vanguard has finally caved. The firm that built an empire telling everyone to stop day trading and touch grass has now opened the door to Bitcoin ETFs for their clients. This is the equivalent of the most conservative institution in finance admitting that the thing that they have dismissed for a decade is now required for survival. For years, remember this, Bitcoin adoption hit a ceiling because one of the largest pools of long-duration capital was locked behind Vanguard's moral lecture about prudence and discipline. Their entire brand was, "We hate fun," and somehow Bitcoin got lumped into the same emotional category as skydiving and recreational drugs. But now that wall is totally gone. 20 million Vanguard clients now have access to spot Bitcoin exposure inside the same accounts that they use for retirement savings, index funds, and their accidental Tesla bets from 2020. That is $3 trillion of brokerage assets that can now press a button and allocate to IBIT and other Bitcoin ETFs without asking permission from a compliance officer who still thinks that Bitcoin is for gamers. The real question is, though, how much mechanical demand does this unleash? And how fast Bitcoin's supply-demand balance gets rewritten? This is an adoption event that is measured in the billions and not in tweets. It changes the ETF flows, it changes the benchmark construction, it forces every advisor who built their identity around being skeptical to quietly buy Bitcoin at 9 p.m. with the brightness turned down on their phone. So we're going to walk through the numbers. We're going to talk about the allocation scenarios and the supply absorption of Bitcoin. And once you see the math, you will understand why this decision is one of the most consequential shifts in the entire timeline of Bitcoin's integration into the global capital markets. Here's the part that nobody in legacy finance wants to talk about. Vanguard isn't just big, fellas. Vanguard is so large that when it shifts direction, the entire market ecosystem adjusts, whether it likes to or not. The platform holds $11 trillion in assets, which means it effectively runs a shadow government for global capital allocation. If you want to understand why this reversal on Bitcoin matters, this is the slide that you need to stare at. Vanguard has over 50 million clients, and most of them are not degenerates that are chasing weekly options. They're normal people who spend their weekends shopping at Home Depot and their evenings Googling, should I rebalance my portfolio? When a firm with this demographic profile finally enables Bitcoin ETFs, it signals that Bitcoin is no longer considered some fringe product for people with standing desks and too much free time. But the real story here is the $3 trillion inside the self-directed brokerage accounts within Vanguard. This is the cohort with something called autonomy. These are the investors who don't need a committee meeting to press buy. They can allocate to IBIT or another Bitcoin ETF without asking permission from anyone, and they do so inside accounts that already hold the bulk of their long-term wealth. This is the capital segment that creates immediate inflow potential, not theoretical Bitcoin adoption happening years from now. And that's before we even touch the retirement side. Vanguard administers over 5 million defined contribution plans with an average balance of roughly $148,000. The moment those self-directed windows expand to include Bitcoin, the second wave is then gonna hit. That wave, though, is structured, it's automated, and entirely insensitive to short-term price fluctuations. If you put all of this together here, the picture is very clear. Vanguard isn't adding a product. Vanguard is enabling a multi-trillion-dollar investor base to participate in the hardest supply asset on earth with a single click. The size alone changes the market that we're in. The structure of the demand compounds it, and the timeline accelerates that the moments that this access goes live. And the timeline is going to accelerate because the access to this is live right now. When we talk about the Bitcoin ETFs, IBIT is dominating the category so aggressively that everyone else is basically competing for the leftovers. Nearly $70 billion in assets under management, with $63 billion of that coming from net inflows. That means that IBIT didn't grow because of Bitcoin price movement. It grew because the market keeps throwing money at it faster than any other ETF launch in the history of the United States. The current estimate is that IBIT captures around 60% of all the Bitcoin ETF flows. That is not an opinion. That is the scoreboard right now. Every retirement account, every RIA platform, every wealth manager who wants Bitcoin exposure has almost always picked IBIT because nobody ever gets fired for choosing BlackRock. That's the entire competitive advantage distilled into one sentence. Now, if we look at the supply side, IBIT controls over 3% of all the Bitcoin that exists in circulation. That is a very structural number. Once an ETF holds that much supply, it doesn't just reflect the market, it starts to shape the market. Every $1 billion into IBIT removes another 9,500 BTC from the available supply, and none of that is coming back onto the market voluntarily. These holders didn't sign up for trading, they signed up for retirement, long-term holding. And the Vanguard change is the accelerant because once the last major platform barrier disappears, IBIT's path to $1 billion assets under management is no longer hypothetical, it's really just becoming a timeline question. Vanguard brings in the exact type of capital that doesn't chase headlines. They're very conservative. They don't panic sell. They don't care about weekend volatility. It just allocates and keeps allocating. So at this point, the conversation isn't about whether IBIT is a market leader. It is about how large it becomes when the tens of millions of Vanguard accounts suddenly gain access to it. Now I'm going to show you what those numbers mean when the capital flows are set free at scale. Now I want to quantify what Vanguard's access actually means in the real world. These three scenarios are not my fantasies, people. These are the straightforward allocation math based on a $3 trillion self-directed brokerage base and the flow patterns that already exist in every other asset class. The conservative case assumes a 0.25% allocation. That level is so minimal it wouldn't even show up in most client reviews, yet it still sends $4.5 billion into Bitcoin ETFs and roughly $4.5 billion into IBIT alone. That alone would absorb about 43,000 BTC. That is the smallest scenario, and it already distorts supply in a measurable way. The base case uses a 0.5% allocation. This lands closer to what you get when advisors treat Bitcoin like an emerging asset class rather than a curiosity. And guess what? If you guys didn't see, Bank of America is now recommending their private wealth clients to perhaps recommend 4% of portfolio allocations to Bitcoin. So yeah, the advisors are treating Bitcoin like an emerging asset class, and there's nothing anybody can do about it. It's happening. This base case result produces $9 billion captured by IBIT, 86,000 Bitcoin, and the aggressive case is a 1% allocation scenario that would be $18 billion to IBIT, absorbing 171,000 Bitcoin. And you have to understand this 1% is very modest compared to standard positions in commodities, and we all know that Bitcoin is a digital commodity. It's an emerging market. The reality is that none of these scenarios require speculation. They are driven by the standard asset allocation behavior that is going to be recommended. Once Vanguard removes the access barrier, these flows become a mechanical function of how investors diversify. That's why this slide matters. It shows the scale of the demand and the direct impact it has on the supply the moments that the Vanguard clients are allowed to press their buy button. Now, up to this point, we've talked about the numbers, the inflows, the supply absorption, but the reason Vanguard's decision is so consequential, it actually goes far beyond the math. This changes the architecture of how capital behaves in the real world. We can start with the retirement gateway because Vanguard services over 5 million defined contribution participants. These are people who do not time markets, they don't chase narratives, they do not care about Fed minutes, they contribute every 2 weeks because HR told them to. And once Bitcoin enters those self-directed 401k windows, you get a steady stream of price-insensitive investors and demand that compounds for decades. Nothing else in the system behaves like that. It's slow, it's consistent, and it never stops. And next is the fiduciary cover. Advisors benchmark to Vanguard the way that politicians benchmark to poll numbers. You have to remember this. If Vanguard approves something, advisors can recommend it without risking their career. Before this, Bitcoin exposure was treated like a professional hazard. After this, though, ignoring Bitcoin becomes the hazard, and that single shift flips the psychology of an entire advisory industry that manages trillions upon trillions of dollars of capital. And then we have the benchmark inclusion, the moment that target date funds and model portfolios, they treat IBIT as a standard sleeve. Every competing platform is forced to follow. Think TIAA, think Pershing, thousands of registered investment advisors. Nobody wants to explain to clients why their retirement portfolio is missing an asset that every major benchmark now includes. In finance, embarrassment is more dangerous than volatility. And finally, I just have to mention this. We have to mention the psychological shift because Vanguard, if you remember, Vanguard built its reputation on conservative, evidence-based investing that doesn't chase trends, it doesn't pander. When an institution with that profile greenlights Bitcoin ETFs, it sends a very, very clear signal. Bitcoin is no longer optional. It has moved from a speculative curiosity to a legitimate component of long-term allocation strategy. That narrative shift accelerates adoption among wealth managers, endowments, and corporate treasuries that were waiting for someone exactly like Vanguard to validate the move. So when you add all of this together, the takeaway is very simple. Vanguard didn't just open access. It removed the final social institutional barrier preventing Bitcoin from entering the mainstream financial system. The numbers, they just tell one story. This slide tells the bigger one. And here's where the numbers stop being abstract and start being uncomfortable for anybody pretending Bitcoin is a niche asset. US spot Bitcoin ETFs already hold around 6.5% of all the Bitcoin that exists. That percentage has been reached in under 2 years. No asset class, no commodity, no anything has ever been absorbed at that pace by regulated vehicles designed for retirement accounts. And this is before the largest passive allocator in the world opened the gate. Now, if you add Vanguard's absolute base case flow, about 86,000 Bitcoin, which is what you get from a 0.5% allocation on their self-directed base, that alone pushes the ETF ownership towards 7% or more of the circulating supply. So I'm not projecting a hypothetical future. I am describing a flow dynamic that activates the moments that Vanguard clients can press buy. And this is where everything comes together because the impact is not theoretical. It shows up directly in the asset growth and the revenue and the structural behavior of the market itself. We can start with the IBIT assets under management trajectory. Remember, if we are aggressive, which honestly isn't that aggressive in my humble opinion, we're talking about $90 to $100 billion flowing into IBIT within 12 months. And then there's the fee impacts for BlackRock or another Bitcoin ETF. But for BlackRock specifically, every $10 billion in new assets generates roughly $25 million a year in sponsor revenue at a 0.25% management fee. So Bitcoin ETFs are going to stop being a niche product and they're really going to start becoming a high margin business line. And you think when BlackRock recognizes this, that means the marketing machine starts to activate and advisors suddenly discover that Bitcoin improves risk-adjusted returns. This is how adoption spreads in practice. Money talks, and it talks loudly. And then you have the market structure shift, the retail traders panic, institutions rebalance, but retirement flows, they just keep on buying. They don't care about CPI prints or rate decisions. They allocate unscheduled. And this cohort's going to begin to absorb supply. The drawdowns, that means the drawdowns get shallower and the rallies last longer because profit-taking supply gets swallowed by systematic inflows. This is the foundation of a more mature Bitcoin market driven by long horizon capital rather than weekend gamblers. And finally, the strategic signal to the market. Vanguard's capitulation ends the illusion that Bitcoin is some fringe speculation. When the most conservative allocator in the world accepts it, Bitcoin transitions into a legitimate, standardized component of portfolio construction. At that moment, it becomes materially harder for any advisor, endowment, or corporate treasury to justify ignoring it. The social cost of skepticism rises, and the professional incentive shifts toward inclusion. So the bottom line impact is simple: higher assets under management, higher revenue, a stronger Bitcoin market structure, and a complete reversal of institutional psychology. This is how Bitcoin moves from the edges of finance to the center of asset allocation. This is tremendously bullish news for Bitcoin and yet another capitulation from a major institution to the apex asset. My name is Adam Livingston. I am the Bitcoin Wizard. If you enjoyed this content, please like this video and subscribe to Swan Bitcoin, where we bring you the daily Bitcoin insights better and with more energy than anybody. Have a terrific day. Do not party too hard. Class dismissed.